Good morning, friends. Myself Dinesh from Fundamental Research. I'll be discussing the bank's Q4 FY13 earnings preview. So we expect banks under coverage to report a decline of 4.2%, for Q4 FY13, mainly due to a weaker performance by the public sector banks. The public sector banks are expected to report about 16% decline on a YoY basis in earnings. This will be largely contributed by the slower growth in the net interest income, fee income, and high provisions. On the other hand, private sector banks are expected to demonstrate a stronger growth. We expect private sector banks to show a growth of about 20% in earnings in Q4. Coming to the operating performance, we expect operating performance of banks to remain subdued in Q4. That would be largely due to a slower credit growth and a decline in margins on a YY basis. The public sector banks are expected to show an NII growth of about 5% YoY, whereas private sector banks would do better. They are expected to show an NII growth of about 21% on a YoY basis. Asset quality in this quarter will be a key monitorable. We believe the slippages of the banks, especially public sector banks, is expected to remain high in Q4 as well, though there has been some moderation in Q3, but we believe that given the current economic scenario, the slippages will remain in Q4 as well. However, the key silver lining is that that the recoveries in this quarter is likely to improve due to the strong recovery efforts by banks. So that should lead to slightly lower addition to the net slippages. This quarter, the outstanding restructured books of banks is likely to remain stable, as banks will be able to upgrade a part of restructured loans as per the RBI notification. But the pressure on the restructuring remains as there has been additions to the CDR pipeline. This quarter, treasury income would be slightly better, but unlikely to support the earnings growth in a major way. The bond yields have declined. That gives opportunity for banks to book trading gains, but the fee income, which is a larger part of the non-interest income, is likely to show a tepid growth. So, looking at the overall scenario of the banks, we remain selective on the banking sector. Banks stocks have underperformed on YTD basis due to slower than expected recovery in the economy, which is leading to asset quality issues. Also, the RBI has been, giving a cautious guidance as far as the monetary easing is concerned. So that has actually led to underperformance. Going ahead, we believe the earnings growth of banks, especially PSU banks, is expected to remain under pressure due to a slightly prolonged recovery in the economy. Therefore, we are very selective on the sector. We prefer banks which could revive strongly in case of economic recovery, and which are slightly better in terms of asset quality. So we prefer ICICI Bank, Yes Bank, and Federal Bank. Among PSBs, we prefer SBI and PNB. We also prefer HDFC Limited in the NBFC space. Thank you.